Fintech and blockchain, the truth about modern payments. 15 years ago, Bitcoin promised to eliminate banks and create peer-to-peer electronic cash. Today, your payments are faster, but not because of blockchain. Stay with me for the next 12 minutes, because what I'm about to show you will completely change how you understand money movement in 2026. Let me take you back to 2009. The Bitcoin white paper had one promise. Fast forward to 2026, payments are dramatically better, faster, cheaper, more accessible. But here's the kicker. It's fintech without blockchain that changed everything. Well, almost everything. There's one place blockchain actually won, and I'll reveal that in just a moment. Section 1. The two types of money you never knew existed. Before we go further, you need to understand something that 99% of people don't know. There are two types of money in your financial system. First, central bank money. That's physical cash in your pocket and reserves that banks hold at the central bank. This is the ultimate settlement layer, the final truth. Second, private bank money. Your bank deposit. When you see $1,000 in your account, that's just a ledger entry at your bank. It's a liability of the bank and asset for you. Watch what happens when you pay someone at the same bank. Your account goes down $10, their account goes up $10. But nothing moves at the central bank. It's just ledger magic. But when you pay someone at a different bank, now we need real settlement. $10 of central bank reserves move from your bank to their bank. This is crucial. Ultimate settlement always happens in central bank money. Remember this. It'll blow your mind later when we talk about blockchain. The liquidity trap. Now here's where it gets interesting. There are two ways to move money, and this is the difference between waiting 3 days or 3 seconds. Real-time gross settlement. Bank A pays Bank B $10. The money moves immediately. Then Bank B pays Bank C, then C pays A. At the end, everything nets to zero. But watch this. Even though everything canceled out, Bank A needed $10 in reserves and Bank C needed $20. That's $30 in liquidity for just $90 of payments. Now watch batch net settlement. We wait. We collect all the payments. We net them out. Everyone's at zero. Liquidity needed? That's right. Zero reserves needed when you net everything. But there's a catch. You have to wait until the end of the day to get paid. Real-time gross, immediate payment, high liquidity required. Batch net, low liquidity, payment delays. For decades, this was the trade-off. Speed or efficiency. You couldn't have both until fintech changed the game. Section 3. The Fintech Revolution. 2016, India launches something called UPI, Unified Payments Interface, and it changes everything. You tap your phone, the payment shows up instantly. Your friend has the money. Real time, right? Wrong. Here's the secret. It's fake real time. Behind the scenes, banks are still using batch net settlement, but they're crediting you immediately and taking the risk. India created the illusion of real-time gross settlement with the efficiency of batch net settlement. It's financial engineering genius. Over 70% of Indian population now has bank access. 100+ billion transactions annually. Average transaction time, 2 seconds. Cost, nearly free. And the results? 70 countries now have real-time retail payment systems. The biggest 5: India, Brazil, Thailand, Argentina, Nigeria. Notice something? These aren't the richest countries. They're the ones that needed it most. The United States, still catching up. The Square Revolution. Same year Bitcoin launched, 2009, another revolution started. This one actually worked. A tiny device that turned any smartphone into a payment terminal. But here's what people miss. It wasn't just about accepting payments. Square built an entire ecosystem. Payment processing, inventory management, customer relationship tools, payroll systems, e-commerce integration, banking products, data-driven lending. That last one, that's revolutionary. Square sees every transaction, so they can offer loans to businesses that banks would never touch. A street vendor who's never had a bank account. Square sees they make $200 every day. Boom, they get a microloan, sell their goods, repay by end of day. This is financial inclusion that actually works. Kenya's mobile money miracle. But if you want to see the real revolution, Kenya, 2007, M-Pesa. They did something radical, put money directly on SIM cards. No bank account needed, no app, just your phone. 2006, 27% had formal financial access. 2018, 83% had financial access. Excluded population, 41%, 11%. Read that again. They took financial exclusion from 41% to 11% in 13 years. And here's the kicker. Farmers with zero collateral getting microloans based purely on their M-Pesa transaction history. Your data becomes your credit score. So, where's blockchain in all of this? Speed? Fintech solved it. Convenience? Mobile apps, access, light bank accounts, and mobile money. Blockchain was supposed to fix payments, but it failed at retail payments, failed at person-to-person, failed at merchant services, except there's one place it's actually winning. Section 4. The one place blockchain actually works. International payments. And to understand why blockchain works here, you need to see how broken the traditional system is. Watch this nightmare. You want to send money from the US to Korea. Step 1, money goes to your bank. Step 2, your bank sends to an international correspondent bank. Step 3, FX trader exchanges dollars for won. Step 4, money goes to the correspondent bank in Korea. Step 5, Korean correspondent sends to recipient's bank. Step 6, finally reaches the recipient. 6 steps, 6 places someone takes a cut. 37% of transfers cost under 5%, 45% of transfers cost 5 to 10%, 10% of transfers cost 10 to 15%, 8% of transfers over 15%. Let me put that in perspective. Send $100 internationally, there's a 45% chance it'll cost you $5 to $10, and plenty of these take more than a day. A lot of time is spent just chasing around money that was supposed to be in place and isn't there. JP Morgan Chase, 2024. That's JP Morgan admitting their own system is broken. In 2024, not 2009. Fintech solution-wise. 2011, 2 Estonians in the UK got fed up and created Wise. Here's their brilliant trick. They hold big pools of money in every currency. You don't actually send dollars to Korea, you just reduce your dollar balance and increase your won balance. On your end, instant. Behind the scenes, Wise manages the imbalances through smart hedging and FX trades. Fintech solved cross-border payments without blockchain. Blockchain's actual win, Ripple and stablecoins. Blockchain is finally competing and winning in some cases. Ripple, launched 2012. The concept is elegant. Buy a token with dollars. Transfer token ownership on blockchain takes seconds. Recipient sells token for $1 USD XRP token. 2 transfer token 3 seconds. 3 XRP token. When it works, it's instant. But there's a catch. You need market makers willing to buy your token. It's not truly peer-to-peer. You're still depending on financial intermediaries, just different ones. But then 2020, JP Morgan launched JPM Coin, a private, permissioned blockchain, only for them and their clients. This isn't the Bitcoin dream. This is a bank using blockchain technology as a tool, and it's working for large institutional transfers. $1 billion daily. This is blockchain's actual successful use case, not replacing banks, but making them more efficient. Section 5, the uncomfortable truth. So let's come back to that 2009 promise. Peer-to-peer electronic cash, no financial intermediaries. No intermediaries, still need market makers, exchanges, retail payments, Fintech 1. Mobile convenience, apps 1. Financial inclusion, M-Pesa 1. Cross-border efficiency, competitive with Fintech. Smart contracts, new functionality, 1 out of 6. Blockchain succeeded in one category. Meanwhile, Fintech without blockchain delivered real-time payments that feel instant. Mobile-first experiences. 70% financial inclusion in formerly excluded populations. Omnibus account architecture for efficiency. Smart lending based on transaction data. Complete merchant ecosystems. But here's what's fascinating. Blockchain is naturally suited for real-time gross settlement. That's its DNA. But making payments better required all these other innovations Fintech pioneered. The question isn't blockchain versus Fintech. It's, can blockchain adopt Fintech's lessons? Section 6, the Omnibus Paradox. Remember those two types of money? Central bank and private bank? Well, Fintech created a third type nobody talks about. When one Square customer pays another Square customer, nothing happens at any bank. It's just a ledger entry at Square. This is private platform money, and it's growing fast. But here's the thing. We heavily regulate banks because we need the payment system to be stable. But these new platforms, different rules, lighter oversight, they're becoming systemically important without bank-level regulation. And this is blockchain's philosophical problem. Blockchain says decentralized, trustless, peer-to-peer. But Fintech won by doing the opposite. Centralized omnibus accounts with netting. Blockchain vision, everyone has own account, real-time gross settlement. Fintech reality, omnibus accounts, batch net settlement, disguised as real-time. One is pure, one is efficient. Guess which one won? Closing, the hybrid future. So where does this leave us in 2026? Blockchain needs to let go of its 2009 purity. Real-time gross settlement is great, but real-world payments need dispute resolution mechanisms, smart lending based on data, user-friendly mobile interfaces, merchant tools and analytics, compliance with local regulations, efficient netting for liquidity management. The winners won't be pure blockchain or pure fintech. They'll be hybrids. Stablecoins on blockchain with traditional FX backend. Central bank digital currencies, CBDCs, using blockchain rails. Private blockchains like JPM Coin adding smart contracts. DeFi protocols adding KYC, AML compliance. CBDCs, central bank digital currencies, are the next frontier. Over 130 countries exploring them. That's blockchain tech with central bank backing. The future isn't blockchain replacing banks. It's blockchain becoming another tool, like mobile apps, like APIs, like cloud computing, that makes finance more efficient. 15 years ago, Bitcoin promised a revolution. What we got was different, but in many ways, better. 2 billion people now have financial access they didn't have before. Cross-border payments that took days now take seconds. Microloans reaching farmers who've never seen a bank. The revolution happened, just not the way anyone expected. The lesson? Technology alone doesn't change the world. Technology that solves real problems for real people, that's what creates revolutions. If this changed how you think about payments, drop a comment with the one thing that surprised you most, and subscribe, because next week, we're diving into how to strategically position yourself in 2026 to benefit greatly from the AI surge.